IAS 28 Investments in Associates and Joint Ventures establishes the accounting principles for investments where an entity exercises significant influence or joint control rather than full control. These arrangements are important because many organizations participate in strategic partnerships, collaborative projects, and partially owned investments that do not qualify as subsidiaries. Associates and joint arrangements require different accounting treatment from subsidiaries because investors do not possess unilateral control over operations and decision-making. IAS 28 and related IFRS accounting standards ensure that financial statements reflect the economic substance of these relationships appropriately. Within the DIP-IFR syllabus, understanding associates and joint arrangements is essential because such investments frequently influence profitability, strategic expansion, and group financial reporting in multinational corporate structures. An associate is an entity over which an investor has significant influence but not control or joint control. Significant influence generally exists when the investor holds 20% or more of voting power, although other factors such as board representation, participation in policy decisions, or material transactions may also demonstrate influence. Investments in associates are accounted for using the equity method, under which the investment is initially recognized at cost and subsequently adjusted for the investor's share of post-acquisition profits, losses, and other comprehensive income. This method reflects the investor's economic interest in the associate's net assets and performance without fully consolidating the associate's assets and liabilities into group financial statements. Joint arrangements arise when two or more parties share control through contractual agreements requiring unanimous consent over relevant activities. IFRS accounting standards distinguish between joint operations and joint ventures based on the rights and obligations of the parties involved. In a joint operation, parties have direct rights to assets and obligations for liabilities relating to the arrangement. Each party therefore recognizes its share of assets, liabilities, revenues, and expenses directly in its financial statements. In contrast, a joint venture gives parties rights only to the net assets of the arrangement rather than direct ownership of individual assets and liabilities. Joint ventures are accounted for using the equity method similarly to associates under IAS 28. The distinction between joint operations and joint ventures is important because it determines how financial information is presented within consolidated financial statements. Joint operations involve direct recognition of proportional interests in assets, liabilities, income, and expenses, providing detailed visibility into operational participation. Joint ventures, however, are presented as single-line investments under the equity method, reflecting only the investor's share of net assets and profits. Determining the correct classification requires careful analysis of contractual arrangements, legal structures, and rights to assets and obligations for liabilities. Accurate classification ensures faithful representation of economic substance and prevents inappropriate consolidation or omission of financial exposures associated with collaborative business arrangements within international reporting environments. When preparing consolidated financial statements involving a subsidiary together with an associate or joint venture, different accounting methods apply simultaneously. Subsidiaries are fully consolidated because the parent exercises control, meaning assets, liabilities, revenues, and expenses are combined line by line. Associates and joint ventures accounted for under the equity method are presented as investments within the consolidated statement of financial position. The carrying amount of the investment increases or decreases according to the group's share of post-acquisition profits, losses, and other comprehensive income. Dividends received reduce the carrying amount of the investment rather than being recognized as income. This combined approach ensures that consolidated statements appropriately reflect varying levels of influence and control within group structures. Overall, IAS 28 and related IFRS accounting standards provide a comprehensive framework for accounting for associates and joint arrangements within consolidated financial reporting. By distinguishing between significant influence, joint control, and full control, the standards ensure that investments are reported according to their economic substance and governance structure. The equity method allows investors to recognize their share of profits and net assets without full consolidation, while joint operation accounting reflects direct rights and obligations arising from collaborative arrangements. Understanding these principles is essential for DIP-IFR candidates because associates and joint ventures are common in international business strategies, infrastructure projects, and multinational corporate partnerships, making them highly relevant to professional financial reporting and group accounting practice.